Investing is frequently presented as an endeavor governed by pure logic and numerical precision. Financial models, economic indicators, and corporate fundamentals are indeed critical components of any sound investment thesis. This perspective often suggests that successful investing is a purely rational pursuit. However, beneath this veneer of objective analysis, an unseen force profoundly influences countless investment decisions. This powerful, pervasive emotion is fear. It subtly, yet fundamentally, dictates behavior in ways that often defy rational assessment. This pervasive emotion warps judgment, leading directly to costly mistakes and consistently missed opportunities. Understanding its influence is paramount for any serious investor. Failure to recognize its grip can undermine even the most sophisticated strategies. The impact of fear in financial markets represents a complex interplay of deep-seated psychological biases. It is not merely a momentary lapse in judgment, but a systemic influence on decision-making. These biases are often invisible to those they affect. This is a primal response, deeply rooted in our fundamental survival instincts. It overrides careful, rational analysis when a perceived threat emerges. This innate reaction, though essential in other contexts, often proves detrimental in financial markets. Consequently, this primal response frequently leads to impulsive actions. These decisions are driven by the perceived, immediate threat of loss, rather than a reasoned evaluation of long-term prospects. Such impulsivity can be extraordinarily damaging. A primary psychological mechanism at play here is known as loss aversion. This phenomenon describes how the pain associated with a financial loss is felt far more intensely than the pleasure derived from an equivalent gain. The asymmetry is striking. This inherent asymmetry frequently causes investors to make counterproductive choices. It particularly manifests during market downturns, when investors are often compelled to sell at the very bottom, precisely when they should be considering accumulation. This behavioral pattern solidifies losses. Fear manifests itself not only internally, but also through external stimuli. It is constantly reinforced by a barrage of financial news and minute-by-minute market updates. This perpetual flow of information can create an environment of heightened anxiety. Financial media, in particular, often plays a significant role in amplifying market volatility. Sensational headlines and continuous reporting of price fluctuations can create a climate of pervasive anxiety. This erodes investor confidence and encourages emotional responses. The most visible and immediate cost of fear is realized losses. These occur when panic selling ensues during significant market corrections. Investors liquidate positions at depressed prices, turning temporary paper losses into permanent capital destruction. However, a more insidious and often overlooked consequence is the invisible cost, opportunity cost. This refers to the substantial returns foregone by not participating in the subsequent long-term growth phases of the market. Investors who exit prematurely miss out on recoveries. Effectively managing fear involves navigating a critical set of trade-offs. While avoiding panic is undeniably crucial for capital preservation, excessive caution can prove equally detrimental to wealth accumulation. Finding this balance is key. Overly conservative investment strategies, often born from a fear of volatility or loss, inherently limit potential returns. Investors adhering to such approaches may find their portfolios significantly underperforming the market over time, leaving them behind their peers. Consistently making choices driven by emotion rather than strategy incrementally erodes an investment portfolio's value over extended periods. Each emotional decision, though seemingly minor, compounds negatively, hindering long-term financial objectives. This sustained erosion, particularly over decades, can jeopardize critical financial goals. Retirement plans, educational savings, and other significant aspirations may become unattainable. The impact of emotional investing is profound and long-lasting. Surface-level assumptions often attribute investment mistakes to individual weaknesses or a lack of discipline. However, the influence of fear is far more pervasive. It is a systemic issue within financial markets, affecting a broad spectrum of participants. This systemic fear is not isolated to individual psychology. It is heavily influenced by broader market dynamics and external pressures. Macroeconomic events, geopolitical shifts, and even social trends can trigger widespread fear responses. Relying solely on logical frameworks for investment decisions has inherent limitations. Markets are not perfectly efficient machines. They are inherently unpredictable and prone to human influence. This unpredictability challenges purely quantitative approaches. Even the most rational and disciplined investors are not immune to the pervasive effects of market fear. While they may possess robust analytical capabilities, the psychological pressures of extreme market movements can still influence their judgment. Therefore, diversification and a steadfast long-term perspective become not merely advisable, but crucial for navigating market unpredictability. These principles serve as robust counterbalances to the inherent volatility and emotional swings of financial markets. Human psychology dictates that individuals are wired to react emotionally, especially when faced with potential threats or losses. This hardwired tendency is a fundamental aspect of our behavioral makeup and cannot be simply willed away. Overcoming these deeply ingrained psychological biases requires a conscious, sustained effort and considerable discipline. It involves a deliberate process of self-awareness and systematic counter-conditioning to emotional impulses. Developing and rigorously adhering to a robust, well-defined investment strategy is absolutely essential for managing emotional responses. This structured approach provides a framework that guides decisions, particularly during periods of market stress. Fear-driven behavior patterns in financial markets are notably cyclical. They are frequently observed during periods of excessive optimism, leading to bubbles, and then again during subsequent market corrections, prompting widespread panic. Recognizing these cyclical patterns allows astute investors to anticipate and effectively mitigate the impact of fear. Understanding that certain behaviors are recurring helps in preparing a measured and strategic response, rather than reacting emotionally. The common assumption that fear is simply a personal failing, a character flaw, is fundamentally misleading. This perspective oversimplifies a complex psychological and environmental phenomenon. It unfairly places blame without understanding context. Fear in investing is a complex phenomenon, intricately shaped by individual psychological predispositions and the broader market environment. It is a confluence of internal wiring and external pressures, not merely a lack of fortitude. In the modern context, with the proliferation of instant information and constant market fluctuations, managing fear has become an increasingly formidable challenge. The speed and volume of data can exacerbate emotional reactions. Therefore, the ability to effectively manage fear and consistently maintain a long-term investment perspective is no longer just a desirable trait. It is an absolute necessity for those aiming to build a secure and prosperous financial future.